Guys, today we're on my beach. I mean the beach. We're on the beach, and today we've been looking, we've been searching, not stalking though. That's a little too extreme. But we've been intensely following, and you know what? I think we found him, ladies and gentlemen. Today I present to you Bill Hwang's beachfront estate. Alright, let's go take a look. Let's go interview him. Let's see how he lost 20 billion in 2 days.
Julian, do you have something to say?
You talking to me?
Julian, come on.
What? You talking to... Fine, alright, fine, okay. It wasn't really Bill Hwang's house, but I mean, like, from last video, how could you believe me? I mean, it's just like ridiculous. It's like saying that gullible is not in the dictionary. I mean, of course it's not in the dictionary, okay? So, I mean, like, it makes no sense. Well, why would anyone believe me? Today, we're going to be talking about the big Credit Suisse and Archegos Capital drama and how it really all leads back to something we call the margin call. But first, let's give some background. So first, we have Credit Suisse. They're a really big institution in banking and asset management. They manage almost up to $1 trillion in assets. Then we have Archegos Capital Management, and they're basically a family office that manages a multi-billion-dollar portfolio in family money. So what makes Archegos pretty special is really its founder, Bill Hwang. Now, who is this guy? Well, he was like the chosen one in the financial world some time ago. He ran this hedge fund called Tiger Asia Hedge Fund, and this hedge fund managed up to $5 billion. Yes, billion with a B. Now, he was pretty popular until in 2012, he paid $44 million to the SEC and pleaded guilty to insider trading. So it was a very complicated yet pretty interesting story. But that wasn't the end. No happy ever ending. He actually created the Archegos Capital Management and went on to make it a family office, meaning it's only really supposed to manage family money and therefore isn't regulated by the SEC. But now let's talk about margin call, because really margin, which is practically a loan, was the real reason why Archegos, number one, lost 30 to 40 billion left of all their positions. Number two, Nomura predicts a 2 billion loss, and Credit Suisse predicts a 4 billion loss. So what exactly happened? Well, many big global banks were giving margin loans to Archegos Capital Management. And when Archegos defaulted on bank money and their positions, Archegos got margin call. Let me break it down. So Credit Suisse, Nomura, Goldman Sachs, Morgan Stanley, and probably a lot more big banks decided to put their money with Archegos. Archegos wanted these margin loans so that they could trade with more money. You know what they say, money makes money. Now, one major requirement for margin loans is adequate equity. Now, adequate equity ensures that the banks understand and are confident that the borrower can pay them back. Equity is basically the money you own. Archegos' equity was around $10 billion. So what happened then? Margin call happened. Margin call is really when a broker or bank lends me money. Now, I use this borrowed money to buy stocks or invest in the market. Let's say my investments are really poor and my portfolio just plummets, dumps like a rock. So now my broker or banker calls me and says, dude, you gotta put more cash inside the bank so that we're confident that you can pay back the borrowed money. Now, let's say I can't do that because I have no more cash left. Well, then I get margin call. And that's when the bank or broker can really do whatever they want with my investments. In Bill Hwang's case, his family office made really bad investments like Viacom CBS. That's when his family portfolio went into really bearish grounds. And that's when those big banks that lent him money called him up and said that he needed to put more equity inside of his account. But Archegos had lost all their equity. So that is when Archegos got margin called, and that's when these big banks started to liquidate his entire portfolio so that they could pay themselves back. Or at least try to. So all in all, Archegos lost everything, and the banks lost a couple billion here and there after taking a loss from liquidating all the stock positions Archegos had. So the lesson here today is really risk and reward. The more you borrow, the more you can make, but also the more you can lose, just like Archegos. So don't mess around with these margin loans because they can really risk your entire portfolio. You could lose everything, just like you could lose your house if you don't pay back your mortgage. But that's some other content we can get into in another video. Many interesting facts are still coming to light with Archegos, so stay tuned on our channel to find out more about one of the craziest financial stories of all time. Thank you guys for watching. I hope you enjoyed and learned a few things from this video. Be sure to turn on notifications, subscribe to this channel to help us out, and smash that like button if you want to see more content like this. Until next time.